We think silver is highly likely to go, I think, personally, my own positions, which I expose in the report at the end in a disclaimer, is likely to see, $200. And you might even see it within the next handful of months. In other words, within a couple quarters of that breakout. So put your seatbelt on and don't expect normality. You're talking $500. Don't chuckle. I love the continual doubt because that means these people don't have a concept of what's really underlying these markets' bull trend. It's not just another bull trend in gold and silver. This is something far bigger, and they don't grasp it. Silver's also broken out of its what we call the idiot range, which it's been in for 50 years. $50 for $4, $50 back down, 50 years in a range, an old normality. We showed in reports a couple months ago a similar situation in copper and lead that had prevailed back in the 70s through 2005 to 2007. It's like multiple decades of range-bound action by both those base metals. And in 2005, copper broke out of that range, and in 2 quarters, it quadrupled in price and then lived in a new reality subsequently. Now it's breaking out again to another reality. Lead did the same thing. In other words, when it finally decided in 2007 on its own merits to break out of a multi-decade old reality, it quadrupled in a matter of a couple quarters. What's going on here? Well, it's when a market discovers, oops, I made a mistake. I shouldn't have been here that long. Boom. Markets make mistakes. They're not rational all the time. I think we've begun a phase in silver that we've explained to our subscribers over the last handful of months is likely to be a jolting one that takes silver to what we call a new reality, meaning not just doubling the price, but, more likely quadrupling or more the price. It's the issue of the relative performance relative to, one, the stock market, meaning a breakout that is clear, technically speaking, in which the performance of gold, for example, versus the S&P is no longer a duel, which for the last 10 to 11 years, if you looked at a spread chart of gold divided into the price of the S&P, you'd see this basing pattern with ups and downs within it, in which case gold outperformed for a year or two and then pulled back some, and, so basically sideways, where it was basing relative to its performance to S&P. It broke out of that pattern in November. And now it's 1 month later and we've gained hundreds of dollars and the spread has continued to explode. Lo and behold, it broke out also in November, meaning, which place should I be, the U.S. stock market or gold and silver miners? Well, it said gold and silver miners. Well, they've roared since November. They've been roaring before that, but this thing said something just began, and silver did the same. But the other thing that we thought was more important for silver is that it broke out versus gold. Meaning that if you want to allocate assets to monetary metals, fine, that's what these charts tell you to do. But within that complex, you want to preference silver. It's likely to lead.
Michael Oliver predicts silver will reach $200 to $500 in the next 6 months as it breaks out of its 50-year idiot range. He reveals silver has broken out versus gold, signaling it will lead the monetary metals complex. Oliver explains markets are entering a fiat currency crisis, with silver likely to quadruple within 2 quarters.
Gold is now always been the mama market of the monetary metals. Okay. People forgot that silver is also a monetary metal and has been for thousands of years and is likely to become so again. Okay. The poor man's gold. But gold, if you just simply go back, and I've said this over and over in interviews, that if you go back and look at the last 50 years of gold and put it on a ratio scale chart, like I mentioned about silver, $4 to 50, back and forth. If you take that same log scale, it says you're going to 500, to match the dimension. In the case of gold, though, it's had a high at $850 in 1980 from a low around 100 in 1976. So 3.5-year bull trend, 8-fold gain times the bare low. Okay. Then in 2001, you made lows at $260-something gold, and you went to 1,920. Oh, it took you 10 years to do it. Eightfold move. So ratio scale, the same dimension, though much higher each time, okay, on the log scale chart. Now gold is beyond the 2000 high in 1920, and if you measure from the bear low that preceded where we are now, that was 2015, gold made a bear low at 1,050. Eightfold says mid 8,000s. Okay, right now we're 4,500. We're only fourfold into the same type of move we had twice before in 50 years, under conditions that are nowhere near as dynamic, fundamentally or technically, as existed then. We're much stronger. We have much more potential. So when I say 8,000 gold, that's not a prediction. That's saying, hey, if we simply do the norm one more time, we'll be 8,000. Well, can you imagine where silver might be, given the fact that it's breaking out versus gold or spread relationship? And I'm arguing that if you go back over the last 50 years and look not at the range of silver, but where were its spread readings versus gold? What was its relative value? In 1980, it was 6.5% of the price of gold. In 2011, in that bull run, it was over 3% of the price of gold. Right now, we're just above 1.5% of the price of gold. Imagine if the relative performance, which again is technically broken out, matches or exceeds the relative performance level it saw in the last 50 years, like price has already done. What if the spread does the same thing? Silver goes to beyond 3% of gold, or maybe beyond 6.5% of gold, particularly in the next 6 months. That means if gold's 8,000, you do the math. Your jaw will drop.
Similar to copper and lead's breakouts. He warns of a potential mid-cycle correction around month 3, but emphasizes this is a new reality move, not normal market behavior. Gold targeting $8,000 based on historical eightfold moves. Retail investors are desperately selling silver while institutional players accumulate, signaling economic distress beneath surface optimism. Subscribe to Fine Metals for future updates.
If you go back and examine the two acceleration phases of silver that occurred within the old reality, that would have been 1979 to 80, when after years of advancing already at that point, silver exploded. It like quadrupled in a matter of 5 months it was. Went from like $12 to 50, okay? And then in 2010 and 11, again, after years of advance, so it wasn't like some new game, silver doubled in a half in about 7 months. But in the middle of both those moves, if you micro-analyze them, which we've done, there was, in fact, a midpoint, what you might call stumble or a midpoint pause or a midpoint correction. At that point, we're going to be focused at MSA on trying to define any midpoint stumble. It will be a fake out, but we still know that there's a lot of, including myself, a lot of investors who are positioned in call options and therefore are sensitive to such fluctuations. So it would be an important thing to avoid if you can, but you don't, as an investor, want to get out of silver at that point. Where are you going to be at the midpoint of that move? Could be very interesting. Are you going to be 80, 95, let's say $95 to $100? And I picked that because that's a stupid level. Why is that stupid? Because if you take the arithmetic range of the past 50 years and you simply add it to itself, the target would be roughly somewhere close to 100. That correlation, by the way, is a coin toss. We've studied it, put out reports at length going back to the 50 years or so, examining the movements of gold, the miners, etc., during stock market downturns. And the response by gold, the gold miners, silver, it's a little bit different each time, but not always do they respond to sharp stock market downturns. And plus, I say sharp because the stock market could go down and it won't affect silver and gold at all. I mean, you look at 2007, let's take as an example. It peaked in October 2007, dropped November, December, January, February, March. 6 more months passed while the stock market was declining, not collapsing, declining hard though. And gold was continuing up, and miners were continuing up during that same 6-month period. It was only when you got to September, October of 2008, a full year after the bull market peak in stocks, way off the price high, that finally gold and the miners and silver have a very sharp drop that seemed to be correlated to the S&P, although they certainly weren't correlated in that first year of the bear market of stocks. So it's an iffy correlation. The stock market decline is not going to commence right now because we've already wasted too many months on monthly momentum of the S&P or NASDAQ and trying to go down on those metrics. You get downward readings on momentum, yet price was just struggling sort of sideways for especially the last 3 months. So when we see that waste of time on momentum, where there is a decline on the momentum readings, but no real response by price, then as far as we're concerned, for the moment, the bear clock is over. They've had their chance. We're likely now to see, and we said this in a report 2 weekends ago, you're likely to see further gains in the S&P before you even start to top again. So in other words, we could see the stock market roll over, gold continue on up, silver, etc., and not see the stock market really get kicked in the shin until you get down into that 55, 5400 zone. There's technical reasons for that. When you hit that level, you could see a sharp drop. But who knows? Maybe at that point, you're in April or May, and suddenly you're 6 months on silver or over, and silver's reached some kind of level like 200 or 500 or whatever, and has a sharp correction coincident with a stock market break, but at a new reality level. Not only are credit card limits, maxed out and delinquent and all that kind of stuff, but people are selling their granddad's jewelry, grandmother's jewelry and coins and stuff. What does that tell you about the comfort level of the public? I thought everything was going well, and that's what we hear from above. How come people are having to sell their grandparents' silver? And in 9, 10 months from now, they're going to want to turn around and wish they hadn't. In fact, it's probably a motivator for silver because it tells you how weak the economy is. And when you kick the shins out from under the legs out from under the stock market, even just taking it down, let's say 20% in arm wrestling pullback, that's going to shock a lot of people too, because that's the only thing they got to smile about is, hey, my retirement account's up on the year. Take that away from them. Don't crash the market. Just ooze it down 20%, and the despair will hit. That's when you get emotion and political consequences like total fragmentation of the norms of the political system. Like, you've got Democrats, Republicans forever. No, not necessarily. You might end up with third parties that are vying with them and have equal public support, in which case you don't have a two-party system anymore. Already the parties are fragmenting badly. It wouldn't shock me to see new parties arise, radical left, libertarians maybe, who knows. Things are changing. And I think the selling of that silver by these people is desperate. It says how badly things are changing. That's ultimately good for monetary metals, especially since 2024, when we said, okay, gold's coming out of its sideways range. We've been stuck just above 2,000 for a handful of years. Got over 2,000, they'd sell it every, like a ceiling. And in March of 2024, as it was coming up over 2,000 yet again, we said, this time's different, it's going to take off. Well, it's been 2 years now. Not quite 2 years, because that was March of 24. And silver's doubled in a half from that level. And all along the way, if you went into the internet and looked at analysts and listened to, chief gold analysts from this or that brokerage firm, you'd have heard repeatedly, it's got to correct down to here. It never did. It would always give you some kind of correction. Recall April, May, June, July, and I think partly into August, gold was capped at 3,500. They just couldn't get a correction going. I think all they could create is a stall. And then since October, we had the October high just short of 4,400, and they tried to cap it again. This time the cap only lasted a month and a half. And, they keep looking at it's now gold's got to go back to 3,500, I hear. Or silver, it's got to go to 40. I don't know what these people are smoking, but, I'm very happy to hear it. We've been arguing that since early this year, when the S&P was like just below 6,200 at the peak then, that what you're going to see is a topping process. Could involve a year. That's what happened in 2000. That's what happened in 2007. It took a whole year of this twisty-turny but slightly rising action to top it out. But the structures that we see on momentum that could cause a precipitous drop, there have been times when they do, but there's also been times when the Bloomberg Commodity Index correlates to gold. So, you can't say corn is like gold, okay? You get the point. So platinum broke out by our metrics a handful of months ago and has since roared. But it did it pretty much in sync with the Bloomberg Commodity Index and, let's say, the action of copper, for example. So we think quietly it is a precious metal. It is not a monetary metal. And that it's not just a subtle difference. That's important, I think, because ultimately what we're facing here for gold and silver, that's something the analysts just don't seem to get their head around, is that we're facing a fiat money crisis. And we've had like 100 years of that unbacked stuff, and it's finally reaching a crisis point because the focal point now is the U.S. government and Japanese and UK and et cetera, debt markets, their debt. And when you reach that crisis, you've reached the big one. And that's when the issue of fiat currencies comes into question. And already there are movements we know around the world, here, there, in this country, that country, to move more toward a gold-backed situation. And this coming crisis, which, again, I don't see analysts talking about, is going to hit. And when it hits, then suddenly they'll say, gee, that's the reason, huh? Oh, now I understand. Anyway, that's where I think we are, and I think 2026 is going to expose almost all of it.